Hi everybody, this is Alan Ellman, the Blue Collar Investor. As you all know, covered call writing is as easy as riding a bicycle downhill when the market is trending sideways or going up. However, what happens when the market is extremely volatile or even bearish in nature? What actions can we take to maximize our profits and mitigate losses? That's the purpose of today's video. And we're going to break it down into managing existing positions and starting new ones. When we're managing existing positions, there are a couple things we could look at. First and foremost is my 20%, 10% guidelines that I've discussed in my books and DVDs. And what this is we buy back the option that we sold when the premium reaches 20% of its original value in the first half of the contract period. And we're willing to pay up to 10% to buy it back in the latter part of the contract cycle. Now, if the stock is underperforming the market or something has changed regarding its fundamentals or technicals, we may opt to just sell the stock and use the cash to enter a new position. However, if it's just a matter of market forces, we could mitigate losses by rolling down. And that I'd like to show you an example of now. And this is an example that I use in my seminars and my DVDs. The example is a stock HAS, and we're going to use one contract for simplicity. So where you see the red circle on the left part of the chart, that represents October 29th, where I bought 100 shares at $28.50. And at the same time, I sold the November $30 option for a profit of $1.50 per share, or $150 for the contract. Now, as you could see from the green line in the chart, you see that the stock price declined after that trade was made. And where you see the blue circle, that represents November 11th, where I bought back the option, buy to close, at 15 cents, which does meet my 10% guideline, because the option was originally sold for $1.50. Now, once I bought back the option, I was able to sell another option, which is exactly what I did. I sold the $25 call, or I rolled down from the 30 to the 25 in the same contract cycle. That generated a premium of $2. So if you take a credit of $2 and a debit of 15 cents, that resulted in a contract profit of $185. Now, if you could see on your screen towards the extreme right part of the chart, the price of the stock ended up just slightly below $25 at the end of the contract cycle. So that resulted in a loss of about $3.70 or so in share value on paper. However, we generated $185 plus $150, or $335 in option premiums. So the loss was very small. Had we not rolled down, we would have had a more substantial loss. Now, when we enter new positions in volatile or bearish markets, or staying in the game as I call it, there are certain things we could do to again throw the odds dramatically in our favor. And what we're going to discuss in the next few slides are selling in the money strikes, one of my favorites, buying protective puts, which is also called the collar strategy, selling cash secured puts to buy stocks at a discount, or to utilize inverse exchange traded funds. Selling an in the money strike basically gives us downside protection, which out of the money strikes or at the money strikes do not give us. I'm talking about protection of our option premium, or time value of our option premium. I'm not talking about our break even. That's a whole different thing. So if we bought a stock at 32 and sold the $30 call for $3.50, that $3.50 contains both time value of $1.50 and intrinsic value of $2, because the strike price is $2 less than the current market value. The $2 is not profit. The $1.50 does represent initial premium profit. or about 5% for the 1 month. Now that 5% is protected as long as the stock does not decline below $30. So we have $2 protecting our 5% return. That stock can go from 32 to 31.50 to 31, all the way down to 30, and we will still have garnered our 5% 1 month return. The disadvantage of using this strategy is that if the stock goes up, let's say to 35 or 36, we are obligated to sell at 30. So we get no upside. But again, in volatile and bearish markets, this is a strategy that may be right for you. Now, the second strategy I want to discuss is protective puts, or the collar strategy. And that's when we buy a stock, sell the call, and we buy a put at the same time to protect the downside. Let's say an example would be we bought a stock for $48 and sold a $50 call, a pretty typical covered call right. But now, to protect against that stock dropping dramatically in a volatile market environment, we may buy a $45 put. So no matter how far below $45 that stock drops, we have the right to sell it at 45. So our losses will be capped. And the chart that you see on the screen right now shows a typical covered call right with the broken black line. And to the left part of your screen, it looks like the loss is endless. But of course, we would institute an exit strategy before it got out of control. However, the dark arrow shows that the gains are slightly less than a covered call right because we purchased money to buy the put. It cost us some money, or debit, and the losses on the bottom, should this stock deteriorate, is capped at a certain amount. So using the collar strategy is a very conservative strategy and would have application in volatile and or bear market environments. Third strategy, selling cash secured puts. Some people look at it like they're buying the stock at a discount. Now let's say you see a stock that you like that's selling for $30. We could sell a $30 put. That gives the put holder the right to sell us that stock at $30. If the option is exercised, and we're going to receive a premium for selling the put, and a typical premium might be $1.50. Now, if the option is exercised and the stock is put to us at $30, in essence, we've entered that position at a $28.50 because we had a credit of $1.50. So some investors look at it like we're buying the stock at a discount. Once we own the stock, we can then write a covered call on that stock at a cost basis of $28.50. Okay, and finally, there are actually some exchange traded funds that are the opposite of the market. In other words, if the market's going down, these exchange traded funds are going up. They're called inverse ETFs. The four that I look at when I'm using this strategy are PSQ, which is short the Qs, or the NASDAQ 100, DOG, which is short the Dow 30, SH, which is short the S&P 500, and RWM, which is short the Russell 2000. Now, other popular inverse ETFs that I don't use are MYY, which is short the mid-cap S&P mid-cap 400, and SBB, which is short the S&P small-cap 600. And I don't like these last two because they trade on a very low trading volume. So I stick to the other four. And the chart on the right side of your screen shows the behavior of these four inverse ETFs when the market was bearish. The red circle represents the performance of the inverse ETFs, and the blue circle represents the performance of the S&P 500. So in one case it was up 4 to 6%, and the other case the S&P was down 4%. So you can see, but you have to be very, very careful with these inverse ETFs because in most market conditions they're going to underperform. So in conclusion, most market environments will allow us for traditional covered call writing as set forth in my books and DVDs or your particular way of using this strategy. However, there are certain environments where we need to employ other strategies that will change slightly from traditional covered call writing, and those are the strategies I alluded to in this video. Now, I hope you found this video useful. There's a lot more information on these subjects found on my website, thebluecollarinvestor.com, and also in my books and DVDs. You can also feel free to write me directly at Alan@thebluecollarinvestor.com. Thanks for listening. Take care, everybody.